The IRS released the new 2026 tax brackets, and they are already confusing people. So I'm going to break down what's exactly changing, who it affects most, and what you can do right now to stay ahead. I'm Stephen Lee, a CPA and a certified private wealth advisor. We have a lot of information that you need to be aware of, so let's get right into it. Let's start with the good news. The standard deduction is going up again in 2026. For single filers, it's going to be $16,100. For those of you married filing jointly, it's going to be $32,200. And for those of you who are head of household, it's going to be $24,150. Remember, your filing status is determined on the last day of the calendar year, so that's going to be December 31st. That's about a 2.5% increase from 2025. And if you're 65 or older, you'll also get an extra $1,650 or $2,500 if you're married. Plus, there's a special $6,000 senior bonus deduction under the new bill. Seniors could deduct up to $46,700 as a married couple, which can save over $2,600 per year in taxes. But remember, that $6,000 bonus phases out starting at $75,000 for singles and $150,000 for married couples and expires after 2028. Plan your income carefully to stay under those thresholds. The new bill also raises the cap on state and local tax deductions from $10,000 to $40,000. That is a game changer for people in high tax states like New York, California, New Jersey, or Illinois. And if you itemize your deductions, you can now combine property, income, and sales tax up to that $40,000 cap, bunch deductions to get a bigger write-off, including charitable contributions. For tax year 2026, the new bill makes permanent the lower individual tax rates and brackets with slight inflation adjustments. The 7 tax brackets for each filing status range from 10% to 37%. The income thresholds for each bracket are indexed for inflation, and for 2026, the brackets are as follows. For single filers in 2026, the 10% bracket is up to taxable income of $12,400. It goes up to 12%, 22%, 24%, and then it jumps to 32% starting at $201,775. And it goes up to 35%, and then 37% for those of you who are single with income above $640,000. For married couples filing jointly, it starts at 10%, goes up to 12%, jumps to 22% once you exceed $100,800, and it goes to 24%, 32% it jumps again once you exceed $403,000, and it goes up to 35% and then 37% for those of you whose taxable income is above $768,700. Remember, these are marginal tax rates, which means that not all of your income is taxed at, let's say, 37%. All your income below that threshold, let's say it's $600,000, whatever it is, that's going to be taxed at those rates. You're going to have a blended tax rate. We call it marginal tax rate versus effective tax rate. Effective is the average tax rate. Marginal is basically that marginal bracket of income. Everybody's being taxed at 10%, 12%, 22%, 24% as your income goes up. And it's just that incremental dollar that is taxed at that higher rate. So that's the marginal rate. These brackets are inflation adjusted, meaning you can fit about 3% more income into each lower bracket compared to 2025. That could save a typical family between $400 or $1,000 or more, depending on your income level. And if you invest, this part's for you. I hope all of you are investing in some way, shape, or form. The IRS also increased the thresholds for long-term capital gains taxes, and that's the profits from selling investments you've held for more than 365 days. For single filers, there's going to be 3 rates: 0% if your taxable income is under $50,000, 15% if your taxable income is under $307,000, and 20% is anything above. There's also those 3 rates for long-term gains: 0% if your taxable income is under $99,000, 15% if it's under $614,000, and 20% anything above that. And remember, this is just for the long-term capital gains. And if your modified AGI or adjusted gross income exceeds $200,000 as a single individual or $250,000 as a married couple, you'll also owe an extra 3.8% net investment income tax on those gains. But here's the opportunity. If your taxable income is under $100,000 after deductions, your long-term capital gains are effectively tax-free, which is amazing. This is a huge planning window for those of you who are retired or savvy investors, which I hope all of you are. Now, a quick but important note for precious metal investors. The IRS treats gold and silver as collectibles, not regular capital assets. That means your gains are taxed at ordinary income tax rates, but capped at 28%, not 37%. So while you'll never pay more than 28%, you won't qualify for 0, 15%, or 20% rates that apply to stocks. If metals are part of your portfolio, make sure your CPA factors this into your planning because it can significantly affect your after-tax returns on gold and silver. And beyond brackets and deductions, contribution limits for 401ks, IRAs, and HSAs are also increased in 2026. That means you can save and invest more pre-tax dollars, reducing your taxable income even further. And with health saving accounts now covering things like direct primary care and telehealth under the new law, it's another area to take advantage of. Here is your quick checklist. Review your income and deductions, stay under the new phase-out thresholds, schedule that appointment with your CPA, time major income events like Roth conversions. Make sure you're staying under certain thresholds and you qualify. If you're in a high tax state, bunch your deductions and take advantage of the $40,000 SALT cap. These updates could save thousands if you plan ahead, but timing matters. If you found this video helpful, hit the thumbs up button and remember to subscribe so you don't miss my next breakdown of the massive tax changes coming in 2026 and what you must do now. I'm Stephen Lee, and I'll see you in the next video. Bye.